Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to leverage ratios and a projected expansion scenario. In other words, we're going to be calculating the degree of operating leverage, the degree of financial leverage, the combined leverage before we think about our expansion. Then we'll project the expansion out and then calculate once again our leverage ratios. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 531 Leverage Ratios and Projected Expansion Scenarios tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll read through the information, then we'll have a smaller component of that information we will use to work through the practice problem. We have an expansion scenario. We're going to say the cost of the expansion is going to be $2,500,000. How are we going to finance that? So we're imagining a situation where we think that this expansion will increase revenues, and therefore we want to have this expansion. Then we need to think about how we're going to finance it. Well, two ways that are typically the case. We can finance it through debt. We can finance it through equity, possibly. So we have debt. One option, meaning we take out or issue bonds, which are kind of like a loan, of course, issuing the bonds for the $2,500,000, and that will result in us having to pay the 9% interest on the bonds. Or we can sell stock and finance through the issuance of equity. Selling, we're going to say 50,000 shares at a price of $50. Obviously, if we take the $50 times the 50,000 shares, we're going to get up to what we need here. That's going to be our goal. 50,000 times 50 would give us to that $2,500,000. So scrolling down, this is going to be our income statement. So this is the income statement before we do our financing option. We've got the sales, variable costs, fixed costs. It's going to be the earnings before interest and taxes, basically operating income. Notice that we have the income statement basically in a contribution margin type of format, meaning sales minus variable costs rather than sales minus cost of goods sold. And we got the earnings before interest and taxes. Once you get to this point on down, then it's going to be similar, the income statement being in a contribution margin format or a normal income statement. So we got the earnings before interest and taxes or operating income, interest expense, earnings before taxes, and then the taxes, earnings after taxes. And then we have the number of shares that are outstanding before we think about any of the financing options, 120,000. If we take the earnings to 582,400 divided by the 120,000, we get the earnings per share before we do any option, any expansion of the 582,400 divided by the 120,000, or the 4.85 about. So then we're going to have the expected increase in sales once we do the expansion. Once we increase the assets, we think the sales are going to increase by the $1,500,000. That's going to be the increase to the top line. That's why we're doing the expansion, so we get the assets in order for us to generate the increase in sales. Variable cost percent of sales is 30%, and the fixed cost will increase to $1,350,000. Primarily, we would think because we're buying capital assets, and that would increase most likely the depreciation related to the capital assets that we would be purchasing. Then we have the tax rate is going to be the 35%. Compute amounts before the expansion, which is going to include the degree of operating leverage, degree of financial leverage, degree of combined leverage. Create an income statement for the two alternatives that we're going to be thinking about to finance the purchase. And then we're going to compute the amounts after the expansion, the degree of operating leverage, degree of financial leverage, and combined leverage. So here's a smaller recap of the information we're going to need to start working through our problem. We're going to be doing our calculations for the degree of operating leverage before we think about the financing option first. That's going to be our formula here, which is the contribution margin divided by the operating income. We're going to get this information from the income statement. So we're going to be taking we're going to do this in like our tax return type of format as we've seen in the past. I'll do this a bit faster because we have seen this calculation before. We're looking at this calculation here. We're going to be calculating the numerator, which is the contribution margin, which means we're going to take I'm going to calculate it this way. We're going to pick up the sales minus the variable costs, and those are given to us directly on the income statement here, the sales minus the variable cost. So we didn't do exactly this calculation that we did in the past, which is the sales price minus the variable cost per unit, because we were actually given the total sales and the total variable costs. So we'll just take what is given here. So this is a little bit different than what we've seen in the past. Same thing, but We're just taking the total numbers. That's going to give us our contribution margin. Then we've got the contribution margin minus the fixed costs. So if we take the same contribution margin minus the fixed costs, which is the 804, we're going to get to the contribution margin minus the fixed cost of 1,296,000, which is basically simply the earnings before interest and taxes, or the operating income, as can be seen in the formula here. Now we've got our numerator and denominator. We're going to divide these out, the contribution margin divided by basically the operating income. Let's just do it so we can see the rounding that could be involved in these types of calculations. 2100000 divided by the 1296000, we get the 1.62 about. So that's our operating leverage. Remember, when we're thinking about the operating leverage, like any leverage, when leverage goes up, then risk goes up, but so does that kind of multiplier effect, so that if there's more leverage, then you could, in a case of increasing profits, have a multiplying effect, which could be beneficial. In declining times, it could be a problem. It comes with risk. Remember that risk involves the fixed costs. This fixed cost right here is the risk that we're kind of measuring. It often is tied to the capital assets that are purchased, because sometimes it represents kind of our investment in capital assets. A lot of the fixed costs being, or possibly being, related to depreciation. So notice the fixed costs are something we can't basically get out of. They won't change. In other words, if there was a decline in sales, the way variable costs do. But also, if sales go up, if revenue goes up, they're not going to increase the way variable costs do if there's going to be an increase. So that's why it can create kind of a multiplier effect. Okay, so then we're going to go to the degree of financial leverage before we think about our two scenarios. That's going to be this calculations, the earnings before interest and taxes, which we're simply going to pull from our statement, the earnings before interest and taxes, and we're going to divide that by the earnings before taxes, which is going to be this item, the difference being the interest. We're looking now at the financing related to this, and the leverage with relation to the debt. So we're going to say, all right, we're going to say the 1296000 divided by the 896,000 can give us about 1.45 about. And again, same with the other leverage. The leverage adds more risk, but could possibly provide a multiplying type of effect. In the case of increasing times, could be more risky or provide more of a problem in declining times. And then if we have the combined leverage, we can combine these two out, meaning we can take these two and multiply them together. Now, these are two rounded numbers, so that it's not going to come out exactly here, but we can take the 1.62 times the 1.45, and that's going to give us about the 2.34. You can also calculate the combined leverage by taking the contribution margin over the earnings before taxes. Contribution margin we calculated before, which is this 2,100,000. Earning before taxes is going to be here, and that'll be another way that we can get to that 2.34, which is basically combining our two leverage calculations, degree of operating leverage and degree of financing leverage. Okay, so now let's think about our scenario by putting together an income statement under our two scenarios, financing the increase of the 2,500,000, one with bonds, or two with issuing more stocks with equity. So if we think about our income statement, we're going to say the sales are going to be going up to 4,500,000. Why? Because it was before the 3 million, and we think that whatever we do, however we finance this increase of the assets, we think it's going to increase our sales by the 1,500,000. So that's going to be the same whether we finance it with bonds or stocks. And then we have the variable costs. They're always going to be 30%. So that's going to be the same as well. In other words, we're going to be taking the 450,000 times 0.3, and that's going to give us our variable costs. They will change with relation to the sales amounts. Then we're going to pick up our fixed costs, which we think are going to increase to the 1,350,000, no matter what the financing options are going to be, bonds or stocks. Some of that increase possibly, being due to the depreciation related to the assets that we're going to be purchasing, which are most likely property, plant, and equipment type of assets that are going to cause fixed costs to increase. Then we have the earnings before interest and taxes. We'll be subtracting the sales minus the variable costs and the fixed costs. We're at the same point whether we finance with bonds or stocks at this point. Then we have the divergence, with the interest, because the interest that we're going to be paying will differ depending on how we finance the purchase. If we finance it with debt, we're then going to have more of the interest. So if we finance it with debt, we're going to say we got the $2,500,000 times the 0.09 interest rate, which is the 225, plus we already were paying interest of 400,000 plus another 400,000. That's going to give us our 625 if we finance it with bonds, as opposed to only the 400,000, which is what we had before on the books for interest before, if we don't finance with bonds but rather with stocks. Then we've got the earnings before taxes. So notice that this number is now lower because basically the interest expense is a deduction, is going to be an expense, but for taxes, it's going to be a deduction as well. So now we're at a lower number here before we calculate the taxes. And then the taxes are going to be calculated. They're going to be a little bit less for the bonds because we got to deduct the interest. The tax rate is 35%. So if we were to calculate this, we're going to say, all right, we're going to say we got the 1175000 times the 0.35, the 411250, and then on the other side, the 4100000 times the 0.35 is going to be the 490,000. And then we're going to have our earnings after taxes. If we subtract these two out, the earnings before taxes minus the taxes is going to give us the earnings after taxes. So you can see that where the divergence happens with the financing is after basically the operating income or the income before interest and taxes, because the interest will obviously differ depending on the financing, and that will change the taxes related to it as well, making a difference in the bottom line or net income number or earnings after taxes. Now, there's also going to be a difference with the earnings per share, because there's going to be a difference now in the common shares that are outstanding. We had 120,000 shares outstanding before, and then if we financed using B's options, we're going to issue another 50,000 shares. So for B now, there's going to be more shares outstanding, which is going to have an impact on the earnings per share. So we're going to say for A, we had this 763,750 divided by 120,000 is going to give us a 6.36. So notice for A, they finance with debt, which means they got to pay the interest on it, but they're not issuing more equity, which would give more ownership in the company and access to basically the to more of the earnings would be going to the new share, the new shares that have been issued. So on B, we're going to say take the 910,000 divided by 170,000, and that's going to give us about 5.35 on the earnings per share. Okay, so we can see that difference happening now with the financing on the income statement. Now let's take a look at our degree of operating leverage and our leverage calculations for both options being the bonds and the stocks. So the degree of operating leverage, measuring the leverage related to the fixed costs, is going to be the contribution margin, which is now the sales number up top, which is the same for both companies, and the variable costs, which is the same for both companies. And that's going to give us then our contribution margin, the numerator of our degree of operating leverage calculation. Then we have the contribution margin minus the fixed cost or operating income, which is going to be the contribution margin, same for both scenarios. And then the fixed costs, once again, same for both scenarios. We're going to have the same amount of fixed costs for both scenarios here. So that's going to be then, if we divide this out, for both scenarios, the 315,000 divided by the 180,000, that's going to be the 1.75 for both scenarios. So no difference for the degree of operating leverage between the two financing options. Let's take a look at the degree of financial leverage formula. That's going to be for the bonds and the stocks. We got the earnings before taxes and the earnings after taxes. Now the earnings before interest and taxes, I should say, earnings before interest and taxes, that's where we stop. That's our operating income. That's where it stopped being the same, right? Up until that point, it's all the same. Interest is then going to differ now, so it's going to be one of the differing items. So earnings before taxes or after interest here, and then we're going to get our calculation. So we're going to say that we have the 180,000 divided by the 1175000 is going to be 1.53. And then if I take the 180,000 divided by 140,000, we get the 1.29 about. So now we have more leverage, of course, on the bond side of things with the degree of financial leverage due to the fact that they financed with bonds as opposed to the issuing of the stock. So you got the increased leverage for the financing with debt as opposed to the financing with the equity. Let's look at the combined leverage. The combined leverage we can calculate a couple different ways. We can multiply them together. Remember that these are both average or estimates, so meaning there's rounding involved. So we've got about 1.75 times about 1.53 for the bond type of financing, which gives us about 2.68. And then if I look at the stocks, we could take the degree of operating leverage, which is 1.75 times 1.29 about, which gives us about 2.25. We can also calculate that, the degree of combined leverage, by taking the contribution margin, which we calculated up top here, and dividing by the earnings before taxes, which is going to be earnings before taxes, these numbers. And if we divide those out, we should get to our same 2.68 and 2.25, which is going to be the 3150000 divided by the 1175000. There's our 2.68 about, and the 3150000 divided by the 1400000. There's our 2.25. So there's going to be kind of our differences that we can drill down on with regards to leverage when we think about our financing options. When we're thinking about an expansion plan, obviously we're thinking we want more assets on the books so that we can increase our sales. How can we do that? Typical kind of way for a corporation, we can take out debt, or we can take out some type of equity type of interest, common type of scenario that is necessary. And you can think about the leverage options related to them. Obviously, the combined leverage here being increased for the bonds due to the fact that the leverage related to the operating leverage was the same under each financing option, and then the bonds had the greater leverage related to the financing. So they had leverage related to the degree of financial leverage that was greater, resulting in the combined leverage being greater for the bonds than the stock financing option.